Investing is a complex and dynamic activity, and mistakes are often a part of the learning process. By investing I mean putting money into financial schemes, shares, property, or a commercial venture with the expectation of achieving a profit. It's possible to learn and evade investor mistakes and get to know the solutions to these mistakes if they've happened to you before. That's what I'll be talking about in this video. Hello, welcome back to my channel. If you're new here, make sure to hit that subscribe button and the notification bell so you don't miss out on any of our future videos. We release new content regularly, covering topics like personal finance, money management, and economics. Alright then, let's jump right into today's video. Investing is about taking calculated risks with your money to try to earn more with it. Most people invest to achieve a goal, whether it be a long-term goal like retirement or a short-term goal like saving for a down payment on a house. Most people make these investing mistakes that make them lose their money and become more frustrated. Wise people learn from other people's mistakes. You shouldn't wait to lose money on investing, but you should learn and avoid these mistakes. Here are some common mistakes that many investors make. Number 1, lack of research. Failing to thoroughly research and understand the investments being considered can lead to poor decisions. It's important to understand the fundamentals, market trends, and potential risks associated with an investment. Proper research helps investors identify the risks associated with an investment. Without this knowledge, investors might unknowingly expose themselves to higher levels of risk, leading to unexpected losses. Without proper research, investors may not fully understand the investment they're making. This can lead to investing in assets that don't align with their goals, risk tolerance, or investment horizon. Research helps uncover potential red flags like financial instability, management issues, or legal troubles related to a company or investment. Ignoring these signals can lead to investing in entities that are at a higher risk of poor performance or failure. Research can help investors understand market trends and historical patterns. Without this understanding, investors might make poor timing decisions, buying at market peaks or selling during downturns. Without researching the valuation of an asset, investors may end up buying overpriced investments or selling undervalued ones. This can lead to losses as the market corrects itself. Failing to research potential investments can also cause investors to miss out on attractive opportunities that could have aligned well with their goals and risk tolerance. Research allows investors to stay informed about changing market conditions, economic trends, and industry developments. Without this information, investors might be unable to adapt their strategies to evolving circumstances. Number 2, we have emotional decision making. Letting emotions, such as fear and greed, dictate investment decisions can lead to poor outcomes. Emotional reactions might result in buying at market peaks and selling during downturns. A lack of research can leave investors vulnerable to emotional decision-making. When investments perform differently than expected, investors might react emotionally rather than relying on informed analysis. Number 3, chasing trends. Investing solely based on the latest trends or hot tips can lead to speculative investments that lack a solid foundation. These trends can be short-lived, causing losses when the market shifts. An example would include scenarios such as the dot-com bubble, where internet stocks trended significantly higher for a prolonged period of time, allowing investors with timely trades to chase market profits and exit with big gains before the bubble burst. A recent one we can remember is the NFT and cryptocurrency hype that took the internet by storm. Meme stocks and meme coins were being promoted by influencers and celebrities, leading lots of people to lose their money. Number 4, overlooking risk tolerance. Not aligning investments with your risk tolerance can lead to stress and panic when markets become volatile. It's essential to invest in a way that matches your comfort level with risk. Personally, 45% of my investment is dedicated to high-risk, high-reward investments. This is what I'm comfortable with and I like it that way. Go big or go home. Find out what works for you and the risk you are willing to stomach and go with that. Number 5, lack of diversification. Failing to diversify a portfolio by investing in a variety of asset classes can expose an investor to unnecessary risk. Diversification helps reduce the impact of poor performance in any one investment. Diversifying helps improve your potential returns and stabilize your results. By owning multiple assets that perform differently, you reduce the overall risk of your portfolio so that no single investment can hurt you too much. Let's say one section of the market is experiencing a downturn. That downturn doesn't take away your entire wealth. Number 6, market timing. Trying to time the market by predicting when to buy or sell investments is notoriously difficult. Investors who try to time the market often miss out on potential gains or incur losses. You are better off investigating stable companies you believe will still be standing 80 to 100 years from now and putting your money into it. Number 7. Ignoring fees and costs. High fees and transaction costs can eat into investment returns over time. It's important to consider these expenses when evaluating the potential profitability of an investment. Number 8. Short-term focus. Focusing only on short-term gains and ignoring long-term investment goals can lead to impulsive decision-making and missed opportunities for compounding growth. One of the other main benefits of a long-term investment approach is growing your money. Keeping your stocks in your portfolio longer is more cost-effective than regular buying and selling because the longer you hold your investments, the fewer fees you have to pay. Number 9. Not having a plan. Investing without a clear financial plan can result in disjointed decisions that don't align with your goals. A well-defined investment plan can provide a roadmap for consistent, disciplined investing. Number 10. Herd mentality. Following the crowd without conducting your own research can lead to overvalued investments or missing out on undervalued opportunities. Number 11. Overconfidence. Believing that one's investment decisions are always correct can lead to risky behavior and a lack of consideration for potential downsides. Number 12. Lack of patience. Expecting quick and substantial returns from investments can lead to frustration and disappointment. Successful investing often requires a patient approach to allow investments to grow over time. Number 13. Failure to adapt. Markets and economic conditions change over time. Failing to adapt your investment strategy to changing circumstances can lead to suboptimal outcomes. Number 14. Not rebalancing. Over time, the performance of different investments within a portfolio can cause its asset allocation to deviate from the intended targets. Failing to rebalance the portfolio can result in unintended risk exposure. Number 15. Ignoring fundamental analysis. Relying solely on technical analysis or market trends without considering the underlying fundamentals of investment can lead to poor investment choices. In essence, research is the foundation of informed decision-making in the world of investing. It helps investors understand the opportunities and risks associated with their investment choices, and it empowers them to make more confident decisions that align with their financial goals. Without research, investors are essentially operating in the dark, increasing the likelihood of making poor investment choices that lead to losses. It's important to recognize that mistakes are a natural part of the investment journey. Learning from these mistakes and continuously improving your investment approach can lead to better outcomes over time. The fact that you are watching this video shows that you are on the right path. It's better to learn from other people's mistakes than wait for those same mistakes to hit you. Staying educated about investment principles can also help mitigate these common mistakes. That's all I got for you today. Thanks for watching this far. I hope you enjoyed the video. Don't forget to hit that like button if you find this video helpful, and if you have any questions or suggestions, also leave them in the comments section below. We love hearing from you. Goodbye.